super excited to get into what we're going to talk about today because it's market panic. And we're going to be turning market panic into confidence. I don't know about you, but it wasn't too long ago where we had some very vivid memories. Do you remember this? I mean, my parts of me just utterly cringe just thinking about wearing these masks. Oh, I hate these masks from way back in 2020, the pandemic. But the one thing that I want to point out going all the way back there is really the market panic. We had the world shut down. We had some crazy things happen. Everybody remembers this like it was yesterday. But do you remember right when the market just went on its free fall, worst free fall in U.S. history, and in the height of that, for those of you out there that do asset management, do you remember like what happened? Was your phone ringing off the hook? We heard all kinds of stories. There was a lot of panic that set in. I don't think there was mass movement with clients, but I know there was a lot of panic. And I can remember sitting in or walking through grocery stores looking just like this and hearing chatter in the aisles when everybody was afraid to go out of like, yeah, I'm just going to sell my 401k. I'm out. I don't want to lose any more money. Investors and advisors alike were just in a very rough place. And I can tell you going back from that point, thinking about, 4 or 5 years ago at that point, I remember, my clients not really ringing our phones off the hook, but there was a few clients that called our office. You know what they did? They said, hey, is there any chance that we can send you some more money to buy in at this market loss? And it happened about 4 times in the month of May in 2020. And I had a couple clients call in, hey, I just want to hear your voice. Are we okay? You still alive? And I had more clients call in saying, hey, can we invest more money? Now, I don't want to get ahead of myself, but I do want to share a few things about the perspective change, because before that point happened, what really took place was early in my career, I was kind of one of those safe money guys. I was one of the people that, invested in asset management, mostly annuities. In the asset management side of things, I kind of left that to some manager. And I was kind of the safe money guy, and the manager was the one that sat back and, did their thing. And I always kind of set myself apart from that. And that's how I started my career. And then little by little, I started to get into more trying to change my perspective on how good the asset management side of things could be. And then I went to a conference years later, still doing a whole lot of annuities. And on a breakout, or not a breakout session, between days, I was up on a rooftop pool, ended up hanging out in the hot tub with a bunch of guys, talking about asset management, money management. And I'll never forget a conversation I had with 2 managers sitting in that hot tub. Sounds a little strange, I know, but it's a true story. And one of them just changed my perspective talking about dividends. And at that point, I'd known about stock dividends, but I didn't know much. And it started a huge journey for me into really an understanding and unleashing a knowledge of how different asset management could be, specifically in dividend stocks. And then fast forward to where we were, in the pandemic, where, in years past, if I would have went through a situation like that, clients wouldn't fire me left and right. Hey, I want to put more money into annuities and I want to get out of the asset management, because I separated myself. Now I had completely connected myself years later, and I'm the asset manager, and I sell some annuities, but barely. At that time, I really wasn't selling any. I'm selling any now. Not against them, just don't offer them that much. And then what I'm noticing as clients are calling me, say, hey, can we invest more money? So we took a scary situation, and just because of how we poured into our clients, now they're calling us saying, can we invest more money? When most clients were like, get out. My clients wanted to go double down and get more into it. So let's talk about the secret to managing fear is this. What do you think it is? Let's just do on that for a second. What do you think the secret to managing fear, market fear, downturn fear? Here's my opinion: to focus on income, not value. Now, I already said this, but I am no longer the safe money man. I'm kind of the income focused guy. Whether it be alternative investments, which I don't do a whole lot of, annuities, which I don't really do any of, or asset managed, which I pretty much do all of, I'm focusing on the income, not the value, really through very simplistic dividend investing. So I want to talk about 3 examples. I'm going to talk about 3 different stocks. First up is Duke Energy, and I want to show you their chart. This is their chart of the whole year of 2020. Okay, so this is Duke Energy, and I want you to focus your attention right here. Basically, the beginning of the year in 2020, between February and March, you're going to see that they paid a dividend of 95 cents, basically 94 and a half cents, that they paid their dividend at February 13th. And then chaos ensued, and their stock went from over $100 a share down to, at worst, probably 65, $60 a share. So that is a massive drop of 40% in value. Panic is set in. There's chaos. What do we do? The world shut down. Gas and energy. I mean, this is different type of energy than like gas. But what you're going to notice is this, horrible trough of a barbell. I mean, you see 2 big ends and then a big trough in the middle. The very next year, or the very next quarter, when they lost significant value in their stock, they paid the exact same dividend. Didn't even go away. Because one of the questions that we get is, well, what happens when they don't pay their dividend or they lower it? Very few times in U.S. history did we go through such a volatile, crazy time, and yet they paid the same dividend. And then what you're going to notice is 1 quarter. So 6 months later, they raised their dividend, even though their stock is still 30% less of the value it was at the beginning of the year. This is why I love dividend investing. Another one, Benjamin Franklin. Franklin Resources. Look at this trough, like horrible. I mean, you've got like 4 months. Again, this is the same year, 2020, and you're going to see this nasty decline. You're going to see they're paying 27 cents to begin that year, and then at the really the value, or the trough, the valley, that's the word I was looking for, of their stock dip, they paid the exact same dividend. And then you're going to notice they raised their dividend actually at the end of the beginning of the very next year, and their stock was not even to where it was. So you see a lot of volatility in here and very consistent dividend income that they paid throughout the year. Crazy volatility. Like, this is not a fun chart to be looking here, but it's reality. Next chart I want to share. So we had a financial company, we had an energy company, and now we're going to talk about a real estate company. Okay. So this is Realty Income Corporation, own lots of real estate across the world, around the world. And they didn't recover as fast as finance and as fast as energy. So you're going to see this massive blob of value here drop off a map and then never really recover until, a couple years later. And you're going to see they're paying 22 and a half cents right before the pandemic. And then you're going to see 22 and a half cents continued. Again, they got crushed. They weren't allowed to reopen for like almost a year later. I mean, some companies did, but hotels were very slow to recover. So they just got crushed. And you're going to see that they actually raised their dividend and amidst all of this. Why? Because it's a culture. One thing I love about dividend stocks is some companies out there are so passionate about paying their dividend that even in situations like this, where you see stocks not recover for a year or 2, one thing you're going to notice is that they will go to great lengths to continue to pay their dividend. Just like those safe value money guys or safe investor guys out there that are like, hey, we're only going to invest your money for those of you out there that just don't want to lose it. And I get the rationale of why you do that. Well, there are certain volatile stock companies that actually have the same mentality, that we're going to continue to pay our dividend no matter what situations, crazy, world-altering situations where they're going to continue to pay their dividend in the midst of chaos around the world, in your home, online. I mean, everything that we knew it within, a few months flipped upside down, and there was a massive panic that ensued. And yet throughout all of that, we had companies out there that were continuing to pay their dividend. And I love it. I love the fact that they didn't stop paying. So market downturns don't destroy wealth, panic does. There's so much wealth that's being made, and I'm going to do another live session on the value of volatility in dividend stocks. Not going to get into that right now, but the only thing that could have went wrong for clients that had good dividend paying stocks is if when the market went down, they just got out. But a lot of clients understood, hey, let's just hold tight because this isn't a result of bad decisions from a company. This is a global reason that brought everything down. So maybe I should just hold tight. And the people that did that made all kinds of wealth because we all know the market came storming back. Some industries were quicker to recover than others, as you can see of the stock examples I just gave you. But panic is really the destroyer of wealth. We know the markets go up, we know the markets go down. But unless you react because of this reality, we all panic in different situations in our life. As long as we don't overreact and panic into situations that force us to make really bad decisions, we're good. All right. Dividends provide an emotional anchor for both advisors and clients. Why? There's really two, if I were to divide the huge market into two sectors, there's really just two types of stocks out there: stocks that pay dividends and stocks that don't. So you've got stocks that don't pay dividends. We're going to call these growth stocks. So you've got growth, and then you've got value. And I can tell you, growth, there's no anchor. You want to buy low and sell high. When there's volatility, I'm out. Why? Because I got to capture or make sure I keep whatever value when the market's going up and down. I want to sell here and I want to buy here. And that's the only proposition for really making money in growth. In value, you can have the same thing, but you're also getting these dividends that are paying throughout the stock. And you're like, hey, yeah, I know it's volatile, but this stock has great balance sheet. There's a lot of good things going on. They don't have a lot of debt. They have tons of cash to pay that dividend. By the way, that's how companies like continue to pay their dividend, even though their revenue got rocked for an entire year. Why? If you do your research and you understand balance sheets and you understand, payout ratios and how a lot of that works on dividend stocks, you can hold a stock and make very little money, and yet their revenue, I'm not suggesting this, but our average portfolio can pay their dividend for like 4 or 5 years without making any excess profit, without even covering the dividend out of their revenue, if heaven forbid. Now, we don't look for stocks that do that, but the more you know about how this works, the more you're in a position to not panic and to have an anchor. This anchor is so huge because these dividends really are why you keep it. Because if there's volatility, you're like, hey, I need my paycheck. Because I can tell you, clients care more about their lifestyle or care just as much about their lifestyle as they do their portfolio balance. A lot of us advisors really focus on this balance because it's important. The value, what's on your statement, is super important. But to a client, this is almost outweighed by that. There's a connection for sure. But if you can draw the connection to the income that's been generated by the balance or by their portfolio, this word, not the value, because dividend is not determined by the value, it's determined by the company and what they pay per share. So if we can help connect their portfolio and how many shares they own to their income, they don't panic as much about their lifestyle. And that's why we had clients calling us saying, hey, can we give you more money? My first question was, where'd you get the money from? You're retired. Okay. And they're like, don't worry about that. We're not spending all our money. We have more to invest. Okay. So clients, and you know this, you're no rookie in this business. Clients understand that there's equal weight on their lifestyle as their portfolio balance. Sometimes we get hooked into the fact that their balance is the only thing that they care about. And that is not true at all. Financial advisors have a value killer. Okay. Our value killer is custodial statements. I have such a disdain for custodial statements. You know why? Because I spent so much of my time trying to figure out how to get clients to understand what we do and the value we provide for our clients. And they'll sit in my office and we're all on the same page and they're taking ownership of their plan. and they're so into the solution. They're owning it. This is so good. And then a couple months goes by and they're getting their Charles Schwab custodial statements, and they'll call me up 6 months later saying, hey, can I use a refresher? Because I'm just not able to connect the dots between what I'm seeing on my statement and what we talk about in your office. Because in your office, I feel really, really good. And yet month after month, when I see these statements, there's a little bit of confusion. I don't know if you deal with that, but I do. And it drives me nuts. Custodial statements are really good, are designed for two things. First thing is portfolio value. Again, this is that balance discussion that we just had. Okay? This is very big. They want to show and promote the value. And they're also designed for IRS accounting. They're really, to be honest with you, it's really one here and two here. There's really little value, and I would argue there's no value shown on a custodial statement for what you do. Definitely not. Even on your annuity statements, like statements are not designed to promote the value of a financial advisor. They're really designed to make sure everybody's on the right page for the IRS. And then, show you some value, maybe a little bit of monthly history or something like that. So let's talk about custodial statements. So this is an actual statement from a client of mine. I took out all their information so you can't see anything. I adjusted their number, their account number. There's no account number 1, 2, 3, 4, 4, 5, 6. Just doesn't exist. But I can tell you every other number on here is correct. Now, what are you going to notice? There's 4 things that I believe clients care about. They care about how much they deposit. They care about what their balance is. They care about how much income comes in, and they care about how much withdrawals they take out. But they don't think that way, but that's what they really care about, because this, shown correctly, is how you can show your value. So let's look on the first main page of Charles Schwab's statement. Let's see how many times we see this. So like total deposits, 0 times are you going to see deposits like how much money did they put into this account when they first opened it, or how many subsequent deposits. That's not shown anywhere. You have to dig and do all kinds of auditing on statements to see what their actual deposits were, not their cost basis, because cost basis doesn't show value, especially for a dividend guy like me. Because if my client put in $100,000 and invested in stocks and they're paid 5%, that 5% dividend, not growth or loss, that 5% dividend adds to their cost basis. So it looks like they deposited 105. They didn't. They deposited 100. Go 10 years out, they might have a cost basis of $225,000, $250,000. They gave me 100. They have a $200,000+ cost basis, and their value of their account might be 350. And they're only seeing profit of the value that I created of maybe 100, 125,000, when the reality is they made them 250. That drives me nuts. So this becomes a very big discussion point in my office with my clients of the real value we're providing. The balance, it's shown 8 times. 8 times. You can literally look at the value that they're showing on this statement 8 different times. 1, 2, 3, 4, 5, 6, 7, 8. Oh my word. What do you think Charles Schwab cares about? They care about the value. What do they think your clients care about? Just the value. I'm an income guy. I plan for income, hope for growth. But the reality is, what you're noticing here is Charles Schwab only cares about value, and I bet you all other custodial statements out there care about value too. Dividends. Not one time on this main page are they talking about dividends. None. Withdrawals. 0 withdrawals. And the withdrawals drive me crazy too, because there's times when a client might sell a second home, third home, get assets in from something else that's already tagged. They'll deposit it in here, get a 5% yield on their investments, or they're like, hey, we're going to invest it for a year in some low yield investment, and then we're going to take that money back out. And the next year, they're going to show this big withdrawal of $500,000. And we just had this happen this year where clients sold a home, put $500,000 into the account, took it back out 30 days later to go buy their next account or their next house. And the client shows this big drop on their statement of $500,000. Client doesn't realize it was withdrawal. They're just going, hey, we're down for the year. What's going on? Because what Schwab was showing is this massive value, and then the next quarter down a lot. When I'm like, wait, that should have balanced itself out. You deposit, you took it right back out. We didn't even invest it. We kept it in cash. And yet my custodial statement is showing that I lost them money. Who designed this? So this is a big issue. Withdrawals are zero. One thing I can tell you is there's no history for any of this. They're not showing total withdrawals. They're not showing total deposits. They're not showing total dividends. How is the client supposed to understand your value if this is what you do? This is what I do. The next thing, this is the second page. Zero deposits on this, no balances. There's one dividend line that you're going to see right here. Dividends, or actually two lines, but this is year-to-date dividends, and this is quarter-to-date. It's a little bit different number. And then, we'll get the questions from the client. Why are those numbers different? And then we have to go in their statements and figure it out. There's no cohesion there. None. And then there's one line for withdrawals on their statement that you can see right here. I will tell you the biggest problem is there's no history. You can find a little bit of history on their balance, and you can see what the starting value was year to date, what it was at the beginning of the year or the beginning of the quarter, the beginning of the month, depending on the statements kind of shake out. But you can't see what it looked like 3 years ago, 5 years ago. You can't see what your dividend payments were 3 years ago, 5 years ago, 10 years ago. And there's a lot of issues with that, in my opinion. Now let's talk about the solution, then we're going to end this. All right. So the solution is very simple. We created something called Snapshot. Snapshot is to help us show our value. I blanked out all the information of our snapshot. This is exactly what it looks like. We're actually building, and it'll be done here shortly, an automated system, piece of software that we have for our advisors where it's automatic. We're pulling in the data from Charles Schwab automatically or Fidelity or wherever. And then we're able to show these 4 columns. We're able to show deposits, withdrawals, dividend, and value. And now our clients can see a year over year. This client opened up their account April Fool's Day of 2015. That is a reality. It's pretty funny. And then you're going to see they deposited one time $433,000. They never took out any money, hit some RMDs down here as of late. And then I can tell you, here's the history of their dividend. And then here's the history of their value. How cool is this? Their first year, they made just under $10,000 of dividend income. This is real value after fee with our portfolio. They went from 10 to 14 to 19 to 29 to 30, 30 because of the pandemic that you're going to see right here, 33, 40, 44. Okay, we haven't updated this for 2024. But the reality is, look, that is pretty substantial. Outside of the pandemic, we have grown their income. They deposited one time and they went from $10,000 a year to $45,000 a year of income. That is insane. Rate of return on their dividend income with one deposit. And you can see their value went from 433 to 857, which isn't half bad. That we have outperformed the market, but most importantly, we have done a phenomenal job right here. And that's lifestyle. And when you focus here, we focus on income, don't get me wrong, I get paid on this number, so I really care about it. But at the end of the day, they make their money here. And as long as we can do an excellent job there, good things happen. Another one, here's a different one. There's multiple deposits on somebody here, but they've been taking tons of withdrawals. Here's somebody that gave us 1.1 million, added another 70,000 in 2018, and then another deposit in 2022. Total deposits of 1.4 million, taking lots of money out to live. That's almost $700,000 of income, making almost $700,000 of dividend, and yet their account grew over $1 million. So you got somebody that gave us 1.1 in the very beginning. They've deposited a little bit more money, $400,000 more, roughly a little bit less than that. Taken out this is a huge hit to the balance. An annuity could never do this. And then what you can see here is a massive amount of growth. 43,000 of dividend, 98, 97, 92. Again, taking huge amounts of money out. 95, 113, 121. That is substantial. That makes me so happy. I can tell you as a portfolio manager, there is nothing that makes me happier than looking at that right here. I mean, their growth, don't get me wrong, this is pretty awesome. Okay, and even to date, if you look at the balance now, it's well over 3 million. I mean, that is phenomenal. rate of return, and income lifestyle for clients. So I'll give you this for free. All you got to do is type in snapshot in the comments. You want to check this out, I'll give it to you. It's a document that you can do online. You can fill in all of it. Again, we're automating that for our advisors. I'm not going to give you that for free, but if you want the Excel version to start showing a lot more of your value, just type in snapshot into the comment section of this, and I'd be happy to give it away. So hopefully this wasn't too long. There's a lot of information. I apologize for that, but it's super passionate. I'm super passionate about it. And I can tell you, this has totally changed our business. You want to have something like this, just type this in the comments. I'll gladly give it to you. So hopefully you understand how you can turn market panic into a whole lot of investor confidence by making a few changes in how you represent the value you offer to your clients. Hope you enjoy it.